Has your bank balance ever felt stuck no matter how hard you work? Do unexpected bills fill you with dread? Or do you find yourself constantly relying on credit just to get by? If you live in the UK, chances are you're unknowingly falling victim to insidious money habits that are keeping you stuck in a cycle of financial struggle. But what if I told you that breaking free from these traps is simpler than you think? And it all starts with recognizing these hidden behaviors. Stick around, because by the end of this video, you'll discover the 7 subtle money habits that are silently keeping you poor in the UK and exactly how to dismantle them step by step. And as we go through this, tell me in the comments, which of these habits resonates most with your current situation? Many Britons are grappling with persistent financial anxieties, stagnant savings, the gnawing worry of unexpected expenses, the easy temptation of buy now, pay later schemes, or the quiet dread of an underfunded pension. These aren't just isolated incidents, they're often symptoms of deeply ingrained financial habits that, while seemingly harmless on their own, collectively sabotage your long-term prosperity. You work hard, you earn your money, but it feels like it just disappears. This isn't about blaming you, it's about exposing the invisible mechanisms that hold you back. Understanding these common struggles is the first crucial step towards taking back your financial power. So, how do you break this cycle? We're about to embark on a journey that will not only expose these hidden financial traps, but more importantly, equip you with practical, actionable steps to break free. This isn't about radical sacrifices, it's about smart adjustments that will put you back in the driver's seat of your financial future, leading you towards genuine financial freedom and peace of mind. Are you ready to reclaim your cash? First up, let's talk about the silent money drain that creeps into almost everyone's bank account: hidden subscriptions and outdated bills. Picture this: you signed up for a free trial of a streaming service months ago and completely forgot to cancel. Or perhaps your mobile phone contract ended 2 years ago and you're still paying the inflated out-of-contract rate. These aren't just minor leaks, they're steady streams of cash flowing out of your pocket, often unnoticed. Think about all those gym memberships you barely use, music subscriptions, software you downloaded once, or even multiple streaming platforms. A recent study by Citizens Advice found that UK consumers could save hundreds of pounds a year by regularly checking and switching household bills. The average household pays a loyalty penalty of over £800 a year for not switching utilities or broadband providers alone. So, what's the immediate fix? Grab your bank statements from the last 3 months. Go through them line by line. Go through them line by line. Highlight every single recurring payment. Do you recognize them all? Are you still using them? For utility bills, broadband, and insurance, use comparison sites like USwitch or Money Supermarket. They can show you in minutes if you're overpaying.
Don't be afraid to switch, or at least call your current provider and negotiate a better deal. Many companies offer retention deals to existing customers that match new customer offers if you just ask. This habit alone could easily free up hundreds of pounds a year that you can then put towards building your financial resilience. But what happens when you need something and don't quite have the cash? That leads us straight to our next money trap. Our second insidious habit is the seemingly harmless yet incredibly dangerous buy now, pay later trap, alongside the slippery slope of credit card debt. It's so easy, isn't it? That new gadget, a stylish outfit, or a weekend getaway, all just a few clicks away with the promise of pay later. But here's the brutal truth. BNPL schemes often encourage impulsive spending on depreciating assets. And if you miss a payment, the interest and fees can skyrocket. Similarly, high-interest credit cards can quickly turn small purchases into a mountain of debt that feels impossible to climb. The UK saw a significant increase in BNPL usage, with millions now owing money through these services, often without fully understanding the risks. It's a convenience that can quickly become a crippling burden, leaving you in a constant state of financial catch-up. Are you unknowingly sacrificing your future freedom for instant gratification? To break free, you need a proactive strategy. First, cut up those unused credit cards and delete BNPL apps from your phone. For existing debt, prioritize. The debt snowball method, where you pay off the smallest debt first to gain momentum, or the debt avalanche method, where you tackle the highest interest debt first to save money, are both powerful tools. Even small, consistent overpayments can make a massive difference. Remember, every pound spent on interest is a pound you can't save or invest. But what if a real emergency strikes and you're still working on paying off that debt? That's where our third habit, or lack thereof, comes in. This brings us to habit number 3, neglecting to build a robust UK emergency fund. Imagine your boiler breaks down in the middle of winter, your car needs urgent repairs, or you face an unexpected job loss. Without an emergency fund, typically 3 to 6 months worth of essential living expenses, these events don't just become inconveniences, they become financial catastrophes that force you back into high-interest debt, undoing all your hard work. It's not just about covering expenses, it's about peace of mind. A survey by the Money Advice Trust showed that millions in the UK have no emergency savings whatsoever, leaving them incredibly vulnerable. Think of it as your financial safety net, allowing you to navigate life's inevitable curveballs without falling into the debt spiral. So, how do you start? Begin small. Even $10 or $20 a week can build up surprisingly. Set up a separate, easily accessible savings account and set up an automatic transfer every payday. Treat it like a non-negotiable bill. The goal isn't to get rich, it's to create a buffer.
Once you hit your initial target, say £1,000, you'll feel a palpable shift in your financial confidence. This fund isn't for a new TV or a holiday, it's purely for emergencies. Because while you're protecting your present, you might be missing out on a huge chunk of free money for your future. Our fourth poor habit is one many Britons ignore at their peril: not maximizing your UK pension. It sounds boring, right? Something for old age. But here's the exciting part. Your workplace pension is often free money that you're leaving on the table. When you contribute, your employer usually contributes too, often matching your payments up to a certain percentage. This is essentially a pay rise you're ignoring. On top of that, your contributions benefit from tax relief, meaning the government effectively tops up your pension pot. Millions of pounds in unclaimed employer contributions and tax relief go untouched every year because people don't engage with their pensions. Neglecting this is like refusing a bonus year after year. Don't let the complexity put you off. Find out who your pension provider is. Log in and understand your contributions. Are you contributing enough to get the maximum employer match? If not, increase it. Even a small increase now can snowball into tens of thousands of pounds more by retirement, thanks to compound interest. If you change jobs, don't forget your old pensions. Consolidate them if it makes sense. This isn't just about retirement. It's about ensuring a comfortable future free from financial worry. But what about all the money you're spending right now trying to keep up with everyone else? That leads us to habit number 5, falling into the trap of keeping up with the Joneses. This is lifestyle inflation driven by social comparison, and it's rampant in the UK. You get a pay rise, so you upgrade your car. Your friend posts pictures of their new kitchen, so suddenly yours feels inadequate. Before you know it, your income has increased, but so has your spending, often on depreciating assets or experiences that only offer fleeting happiness. Data consistently shows that despite rising incomes for many, personal savings rates can remain stubbornly low, suggesting increased spending rather than increased financial security. This constant desire to match or exceed your peers creates a treadmill of consumption that leaves you perpetually feeling like you need more, even if you have enough. Are you genuinely buying things you need and love, or are you just trying to impress people you barely know? To break this habit, you need to consciously decouple your spending from your income increases. When you get a raise, don't automatically upgrade your lifestyle. Instead, upgrade your savings, your investments, or pay down debt. Practice mindful spending. Before a purchase, ask yourself, am I buying this for me or for someone else's opinion? Unfollow social media accounts that trigger comparison.
Find joy in what you have, rather than constantly chasing what you don't. But how do you even know if your spending aligns with your values? You need to see where your money is truly going. Which brings us to habit number 6, failing to track your money's true path. Many of us simply let money flow in and flow out, with only a vague idea of where it all goes. This is like trying to navigate a ship without a map or compass. You might know your starting point and your general destination, but you're completely unaware of the hidden currents, the unexpected storms, or the treasure islands along the way. Without tracking, you can't identify hidden spending leaks, you can't make informed financial decisions, and you certainly can't intentionally allocate your funds towards your goals. A recent survey highlighted that only a minority of UK adults regularly track their spending, meaning most are flying blind with their finances. Are you truly in control, or are you letting your money dictate your life? The solution is deceptively simple. Track every single penny for at least a month. You can use a simple spreadsheet, a budgeting app like Monzo or Revolut, which have excellent built-in tracking features, or even a pen and paper. Categorize your spending. You might be shocked to see how much you spend on takeaways, coffees, or impulse online purchases. This isn't about restriction, it's about awareness. Once you see the true picture, you can then make conscious choices about where your money goes, aligning your spending with your values and financial goals. This clarity is a game changer. But while you're scrutinizing your own spending, are you aware of how much you're being penalized just for being a good customer? This leads us directly to the 7th and perhaps most frustrating habit costing UK consumers a fortune: succumbing to the loyalty penalty. This is where long-standing customers, particularly in essential services, end up paying significantly more than new customers for the exact same service. We're talking about car insurance, home insurance, energy tariffs, broadcast, and even banking products. Ofcom and the FCA have repeatedly highlighted how millions of Britons are overpaying simply because they don't switch providers. This isn't just a few quid, it can amount to hundreds, even thousands of pounds annually. Are you being punished for your loyalty? The solution is a simple but powerful annual financial MOT. Set aside a specific day or weekend once a year, perhaps your birthday or a quiet period, to review all your major contracts and policies. Before your car insurance renews, use comparison sites. Before your broadcast contract ends, check what new deals are available, or call your current provider and haggle. You have the power to switch. Don't be afraid to walk away from companies that don't reward your loyalty. This proactive approach ensures you're always getting the best value, and it sends a clear message to companies. Customers expect fairness, not penalties. Now that you know these 7 traps, what are you going to do about it? You've now seen the 7 money habits that might be quietly keeping you poor in the UK. But here's the crucial part. Knowing isn't enough. Financial freedom isn't about luck, it's about wise management, protection, and growth. It's about taking informed, deliberate action. Imagine the feeling of having a healthy emergency fund, knowing your pension is growing, being free from the burden of high-interest debt, and consciously directing your money towards your true goals, not just fleeting impulses. This isn't a distant dream. It's a tangible reality achievable through small, consistent steps, starting today.
The power is in your hands to break these cycles and build the financial future you deserve. Don't wait for things to get worse. Start making them better right now. If you found this video helpful, please give it a like. It really helps us reach more people who need this advice. And don't forget to subscribe for more practical UK financial guidance. We're constantly putting out content designed to empower you. Most importantly, I want to hear from you. Which of these 7 habits are you going to tackle first? Share your action plan in the comments below. Your journey to financial freedom starts with that first courageous step. Remember, the path to financial freedom isn't about grand gestures or overnight transformations. It's about reclaiming control, one small, consistent step at a time. It's about building a robust emergency fund, diligently tackling debt, optimizing your pension, consciously tracking your spending, and never settling for less than the best value. By understanding and breaking these 7 insidious habits, you're not just saving money, you're building resilience, creating opportunities, and setting yourself up for long-term prosperity. Take these insights, apply them to your life in the UK, and watch as your financial picture begins to change not just incrementally, but fundamentally. You have the power to change your financial narrative. Start today.